Good afternoon, everyone. My name is Brian Roof. I'm excited to be here today and to help share an economic analysis with our group. To get started, I'd like to introduce my team members and set the agenda for us. So joining me today are my team members, Prerna, Petra, Omar, Ian, and Kevin. And we are with the economic analysis team here at RTP Capital Management. The purpose of our meeting is to look at country level economic guidance and hopefully to help inform investment strategies and decisions as we go forward. There are several regions, international regions that we've studied along with specific countries. We look forward to sharing some of that information with you. So to get started, the first area we looked at was Southeast Asian nations, specifically Sri Lanka. Sri Lanka is a nation with nearly 22 million people with a world GDP ranking of 74th, and that moves between 74 and 76. Its largest GDP component is the service sector. Sri Lanka is a nation built on tourism. Sri Lanka, and it's important to understand that Sri Lanka in 2022 experienced a financial crisis. So the COVID-19 pandemic that came in 2020 had a significant impact on their economic health and well-being. That was compounded with losing access to several international financial markets and poor policy decision making. What happened is that in 2022, their foreign reserves were completely depleted. Their economy contracted significantly. Inflation rose almost immediately, and their currency depreciated over 80% almost instantaneously as that reset. So as a result, Sri Lanka defaulted on some of their international debts. These graphs which we've pulled down from IMF indicate this. You can see on the left the reduction in total foreign reserves leading into 2022. And then on the right, the government gross debt that just skyrocketed in comparison to other Southeast Asian nations. So they were in some troubles in 2022. Now let's jump into where we're at today. So the GDP. As we mentioned, their GDP was really significantly impacted in 2022 with their financial crisis, and some of that impact carried forward into 2023. However, we're beginning to see some improvements. So recently, Sri Lanka has recognized growth in all GDP sectors, including the service sector. Employment, as some of the lag indicators that we're looking at, employment has increased, specifically in the service, but also in the manufacturing industries. So the current rating for GDP is a -1, but we have put the short-term rating 2 points higher at 1 with an asterisk, really pointing out in this spread graph that their GDP growth is actually ahead of other Southeast Asian nations, which is promising. When we look at inflation, Sri Lanka experienced hyperinflation, skyrocketing nearly 50% as indicated in this IMF graph at the top compared to other Southeast Asian nations. It was out of control. This had a significant impact on purchasing power, but in 2023, the inflation began to ease. And it's, as you can see in the Fred graph below, which carries it forward a little further in 2023, it has settled down around 16%. Some of the other indicators are indicating that it's likely to hover in the 10 to 14% range. So as a result of this, we do have the inflation at a -2 rating for current, but have improved that slightly for a -1 in the short term. Again, it's better, but not quite in line with other Southeast Asian nations. Some of the indicators are promising, but we need to see what happens. Looking at the exchange rate, again, as you'd anticipate with a financial crisis, the rupee experienced a rapid depreciation almost instantaneously overnight. When their financial reserves ran out, there was no other option but to depreciate the rupee. However, since that time, in 2023, looking at the indicators, the rupee has actually appreciated, not surprising from the point it was at. Lead indicators such as growth in all GDP sectors, reduced demand for imports, and really the agreement to restructure some of their debt is leading to some stabilizing and slight appreciations for the rupee. So for those reasons, their current rating for rupee is -1. Again, it's better than certainly where it has been. And the short term is 0, a slight improvement given these indicators. Looking forward now, and bringing this all into a concise statement, what we're seeing is that Sri Lanka really has moved from a very challenging financial crisis of 2022. It began to improve in 23, and now in 24, it's showing indicators that it's continuing that trend. Most notably within GDP, trending above other regional nations. So you can see our ratings here. Some, if not most, are in the negatives, but those have been improving with time and with the indicators that we've shared with you. There's much more detail here in the sources that you can dive into. And now I'd like to turn it over to my friends to share the rest of our regions and nations with you.
And I would be talking about Asia Pacific continent and specifically India. So welcome to my section on India within the Asia Pacific region. Now let's move on to my next slide where I will discuss India's economic health by comparing its GDP growth rate with similar countries over the last 5 to 10 years. First, let's observe the GDP growth rate trends for India, Vietnam, China, and Indonesia. India's GDP growth has shown resilience and stability, maintaining a relatively strong growth rate despite of global economic challenges. The 6.5% in 2023 reflects its robust domestic market and industrial output. For Vietnam, we have also seen that it has experienced significant growth after often outperforming its peers. The country's rapid industrialization and export-oriented economy have driven high growth rates, making it a stronger competitor in the region. China's growth, while still notable, has shown signs of slowing down compared to its rapid expansion in the previous decade. This is due to structural changes in its economy, transitioning from manufacturing-led growth to a more service-oriented economy. Indonesia's growth has been very steady, supported by its large domestic market and diverse economy. However, its growth rate has been more moderate and compared to India and Vietnam. In conclusion, India's current GDP growth rate of 6.5% is in line with its long-term trend, suggesting a stable and healthy economic environment. This stability positions India well for continued economic development in the coming years. Next, we move on to the slide, to the next slide, where I will be discussing India's current inflation. Now let's assess India's economic health by examining the inflation rate over the past 5 to 10 years and comparing it to the longer term trend. Um, Let's observe the inflation rate trends for India, China, and Vietnam. India's inflation rate has seen fluctuations with notable peaks and trough. However, it has been generally stayed within a range that suggests some level of stability with periodic increase due to various economic factors. China's inflation rate has been relatively stable with small fluctuations compared to India. This indicates an effective inflation control policy and a more economic with more and a more stable economic environment. Vietnam's inflation rate has been more volatile, reflecting the dynamic nature of its rapidly growing economy and the challenges of maintaining price stability during the rapid economic changes. Now let's move to our next slide, where I would be assessing India's current exchange rate within Asia Pacific region. India operates a managed float exchange rate system. The Indian rupee has shown resilience against the US dollar, appreciating slightly by 0.5% to 83.79 INR per USD as of August 1st, 2024. Now let's assess India's exchange rate strategy and whether the current exchange rate is meeting the country's larger economic goals. First, observe the exchange rate trends for India and China against the US dollars here. India follows a managed float exchange system. The strategy allows the INR to fluctuate in response to market forces, while the Reserve Bank of India (RBI) intervenes occasionally to stabilize the currency and prevents excessive volatility. The managed float system aims to balance the need for competitors for competitive exports with the goal of maintaining import price stability, thereby supporting overall economic growth and inflation control. China operates a managed float system, but with more frequent interventions by People's Bank of China (PBOC) to maintain a stable exchange rate against supporting its export-driven economic model. In summary, India's current exchange rate strategy system has been very effective in maintaining stability and resilience. The slight appreciation of INR against the USD indicates India's exchange rate is meeting its larger economic goals and contributing to the sustainable economic growth and stability. Next, let's move on to our last slide, where I would be talking, where I'm focusing on the key lead indicators and the key central bank policies that are expected to influence India's economic health over the next 6 months. Let's start with India's GDP. The lead indicators, key indicators such as industrial production, consumer spending, and investment trends suggest continued growth. Government policies aimed at boosting consumption and manufacturing are expected to support this growth. The Reserve Bank of India is likely to maintain an accommodative monetary policy to support the growth, which should help sustain the GDP growth rate. In summary, the lead indicators are supportive, and supportive central bank policy suggests that India's GDP is expected to continue grow steadily over the next 6 months. Now look at the India's inflation. Overall, the lead indicators and the central bank measure points towards a stable inflation outlook for the India in short term, with efforts focused on maintaining price stability. And lastly, talking about the exchange rates. In conclusion, India's exchange rate is expected to remain stable in short term, aligning with the country's broader economic goal and supported by proactive central bank policies. That was my slide here, my presentation here on talking about India's short-term and current um, um, factors affecting GDP, inflation, and exchange rates. Thank you.
All right. Hi, everyone, and thank you, Prerna. I will be discussing the current economic state of Hungary, which is a small country located in Central Europe and is a member of several major international organizations. It joined the European Union in 2004 and the Schengen zone in 2007. The local currency is Hungarian forint, as it's still not a member of the Eurozone. And on the global stage, Hungary ranks 54th in terms of GDP. I rank the country's economy or economic status as neutral, with a stable to moderate inflation and stable exchange rates. However, these rates are not fully aligned with Hungary's larger economic goals. In the short term, we are seeing slight improvements, but not to the extent that would significantly upgrade Hungary's economic scores. But I will go into more details in the following slides. Hungary has faced several significant economic shocks recently, including COVID-related supply chain disruptions, obviously surged commodity prices due to the Ukraine war, and delayed European Union funds. These issues have impacted Hungary more severely than other Central European or European Union countries. Despite signs of recovery, Hungary struggles with fiscal imbalances and elevated inflation. And it has a high integration with economies such as Germany and Austria, but also with Russia and China, which makes Hungary sensitive to regional developments as well. So to focus on GDP, in 2023, Hungary's GDP decreased by 0.9% due to high inflation, high interest rates, and weaker external demand. However, economic activity began to recover in 2024, with GDP rising by an estimated 0.8% quarter on quarter. The current growth rate is comparable to Hungary's long-term historical trends, but despite this recovery, the fiscal deficit and the public debt to GDP ratio remain above 2019 levels. Regarding inflation, so inflation in Hungary has been another critical issue. It peaked at 26.2% in January of last year, and it averaged around 17.7% for the rest of the year. And common external shocks had elevated inflation rates across all Europe, but Hungary was recording a much higher inflation rates due to factors like the war, and the war's impact on energy prices, depreciation of the national currency, inefficiencies in the domestic food and food manufacturing industry, etc. By 2024, inflation had decreased to 3.9%, but the recovery of consumption and strong nominal wage growth are set to limit further decreases. Hungary follows a floating exchange rate policy, so after years of nominal depreciation, now the Hungarian forint is strengthening, as you can see from the graphs. The exchange rate of the Hungarian forint has fluctuated much more than regional currencies, with quite some pronounced spikes of volatility during the financial market stress. In short term, a gradual economic recovery is expected in Hungary as households' purchasing power rises, financial conditions ease. GDP growth is forecasted to reach 2.4% short term, mostly driven by domestic consumption and the falling energy prices, lower inflation, and lower interest rates. This could increase investor confidence as well. However, inflation is expected to remain above the central bank's target of 3% in the short term. The general government deficit is also expected to remain elevated. So to summarize, Hungary is showing signs of economic recovery due to gradual reduction of interest rates and moderate energy prices. But the central bank's careful and patient approach means no major decrease in interest rates is expected in the short term despite easing inflation. And lack of progress in governance reforms could result in persistent challenges and prolonged suspension of important EU funds. So, in my opinion, Hungary's economic and political institutions show quite extractive practices with significant state ownership in key sectors that impedes competition. So that was all for Hungary. If there are no questions or comments, I will now pass on to the next speaker. Thank you very much.
Thanks, Petra. Shifting to Latin America, I chose Argentina, and as we all know from the work we've done so far in the course, Argentina has a hyperinflation and economic crisis that it's been going through or for decades, really, at this point. But what's interesting about them is because of political changes, specifically the gentleman you see on the screen, Javier Milei, is the new prime minister. Where it's an opportunity to take a look at the real-time case study and the effects of changing fiscal and monetary policy and the effectiveness of them. So currently, Argentina is still in that economic crisis mode. So -2 GDP, -2 inflation, and -2 exchange rates. However, in the short term and then potentially in the longer term, that GDP and exchange rate are improving. So I gave them -1s. And while the inflation is also improving, that's going to take a little bit longer prospectively. Go to the next slide. So currently, Argentina, it is for all of its ills economically, it's a large economy, number 26 globally in terms of GDP, with a $640 billion annual GDP in 2023 per the World Bank. Now, if you look at the Fred chart on the top, they have their real domestic product of Argentina in the dark blue line. It is on par with some of its regional and then international in terms of industry and GDP size competitors. But if you look at the GDP unadjusted for inflation, it obviously looks a lot bigger. And that just shows the impact of inflation on their economy, that whatever value and whatever growth the economy is having, it's really just sucked out by that inflation. So in inflation, currently this year, we're looking at a 60% year-over-year increase. Last year, we were looking at almost 100%. Year before that, 72%. And that's, year-over-year. So that's exponential. Now, so the 60% is actually an improvement from last year. So maybe this is an impact of some of Javier Milei's policies that he has started putting in effect. But as we know, they are in a hyperinflationary cycle, and that's what this shows. Now, their exchange rate as a result, they're looking at 923 Argentinian pesos to the dollar. If you look at the bottom Fred chart, that's just skyrocketed in the past few years. They have both an official and unofficial exchange rate, and they are working with the IMF they have an extended fund facility that has given them liquidity and helped their economic situation, so they haven't had to have a more severe currency crisis. But as part of that, there's been a fiscal consolidation plan, reduced government spending, and Javier Milei has come in and been working on that as well. So these seems to be having an effect, as we'll look at in the short term. So as we look at the short term, GDP, they are experiencing growth at this point. 1.6% month over month, 2.3 year over year earlier in the summer. And then, an annualized growth rate right now of 7%. Now, it is important to note that this is coming off of a 2023 drought that impacted their agricultural industry. And, this is a little bit of a bounce back just from that. So it's hard to say if it's solely from Milei's policies or more just from this recovery. But either way, it's positive growth, reduced government spending, reduced debt servicing as a result. So this is positive. If you look at the bottom chart, then we look at that's exchange rates. We're talking about the official and unofficial rate in the last slide, and that unofficial rate is dropping faster than the official rate. And Milei is keeping a consistent 2% every month reduction in the exchange rate officially, but that unofficial rate is dropping even faster. Part of this potentially is Milei's stated goal of dollarization, that he wants to shift to using the US dollar, which would reduce Argentina's flexibility in terms of monetary policy, but it would give them a stable currency, which would have a generally positive impact on Argentinians' lives. So continue to look in the short term, their current account has improved after dipping substantially in 2023. And so it has come back up. It's a result of this reduced spending and the inflows that have resulted from that. And then also the government debt servicing has reduced as well. If you look at the spike in the Fred chart on the left in 2023, it's significantly reduced since then. And so this reduced spending, continued attractiveness as an economy, and potential for dollarization definitely make Argentina's future potentially positive. Thank you.
Hello, my name is Omar. I'm going to be talking about the country of Egypt, which is located in Northeast Africa in the Middle East. First, we're going to start with GDP current situation, which has seen a decrease and a slowdown. Historically, it's at 6 to 7% growth year over year. However, more recent data shows that it's about 3 to 4% growth rate. This has been due to several factors. One indicator is the value-added manufacturing, which has been declining over the last few years, especially in the last 2 years. And so given that GDP has decreased below long-term trend, we are giving this a -1 until it recovers back to normal levels. In the short term, we do see a more favorable outlook, given a few factors. We do see some activity in the tourism sector, according to the 2024 Travel and Tourism Development Index. The country has increased 5 rankings since 2019. There has also been a large mega infrastructure projects taking place in the country. The country has, in the last couple of years, has announced a new administrative capital. And also, according to the Oxford Economics Global Infrastructure Outlook, Egypt will see a steady growth in infrastructure investments over the next 3 years. There's also been a large pledge of $35 billion from the UAE to develop large developments in coastal areas of the country. Moving on to inflation, the current situation is pretty bad. Current inflation is about 26%, which is much higher than the 7% target rate set by the CBE. This has been due to several factors, such as the COVID pandemic, followed by the war in Ukraine and the impact on food prices there, and now the maritime disruptions in the Suez Canal due to the conflict in that area. Hopefully, after the CBE has raised the rates to 20%, we should start seeing a decrease in inflation, which we have. I believe the CPI as well as the PPI have decreased somewhat. However, they are still at record high levels. In the short term, again, as I've mentioned, we are seeing some downward trend. However, it's still very high. It's the PPI, for example, is at 478, which is the highest it's ever been. It does not appear that the country will be able to fight inflation in the near term. It might be a more long-term prospect. However, it is moving in the right direction, but there is a lot of improvements to be made in inflation, and especially given food prices and commodity prices in the country. The exchange rate obviously has been very volatile in recent years. This has been largely due to the IMF loan that has been approved for Egypt, and one of those conditions was for the country to float its currency. It has been largely depreciated compared with dollar, about 50 pounds to the dollar, where it was 15 pounds to the dollar just a few years ago. We do not believe that the country is experiencing a currency crisis because this was expected, again, due to the IMF provisions for the loan disbursement. Given that there's greater FDI in the country, foreign investments in the country, and tourism, hopefully that exchange rate will stabilize a little bit. But a depreciated currency is good for tourism. It's good for the country to export its services and goods. So although it's not something that the country wants to see with respect to the volatility. However, it's not to the point where it's a currency crisis or an exchange rate crisis or some sort of currency crisis. In the near term, that should stabilize a little bit. Again, we believe that the pound will remain largely depreciated, so that the country also does not spend a lot of the money that it's getting from the IMF. So we believe that the CBE wants the currency to be largely depreciated. However, they do want to see gradual appreciation of the pound after the economy stabilizes in the short-term future. And that's it for Egypt.
Hello, and thank you to all of our previous presenters. My name is Kevin Finnegan, and I will be leading our last analysis here with the nation of South Africa. So South Africa is the most industrialized within Africa, although it is still emerging as it shifts its reliance from mining and natural resources to a greater focus on financial services and technology sectors. Some historical context is still significant for the country and worth noting here as we conduct our economic analysis. As many know, it implemented apartheid policies in the 1970s. And from that period, it really severely restricted foreign investment and led to some pretty severe trade sanctions, which even post-apartheid in the mid-1990s were still in place. That policy has further led to some lingering issues even today, with extreme poverty and among the largest wealth gaps across the entire world. In addition, there's some more recent political uncertainty. So they had general elections, which were this summer, and even after the elections were over, there's still remaining some uncertainty there. The ANC, which is the legacy Nelson Mandela political party, had held the majority every single election since the parliament took its structure in 1994. But after receiving just 40% of the vote this summer, there's a bit of political jockeying that's occurring. And we'll note that kind of as we progress here in our conversation around GDP, inflation, and exchange rates. So looking at GDP, we are giving South Africa the most bearish rating at -2 for current conditions. As you can see from the chart on the bottom left, which is real GDP growth from the IMF, it has lagged to comparable nations, both in the short and medium term. On that chart, we have the other largest nations in Africa by GDP, and very evidently, they have experienced higher rates of growth. Rates that tend to be closer aligned to developing emerging nations that are similar to South Africa. Also worth noting, a significant drag on GDP for South Africa persists in very essential infrastructure that is underdeveloped. There are high rates of power outages, fairly high prevalence of corruption, which coupled with larger systemic issues have really been a sustained challenge for the country. However, as you can see from the short term, kind of rating we're giving it, we are a bit more neutral as we look forward here. So in the short term, kind of slight change there on the left, bottom left graph. Now we're revealing that IMF projection on GDP growth in the short to medium term, which is roughly in line with its peers on average. In addition, we have some lead indicators that give some level of optimism. So while from an absolute standpoint, consumer confidence is pretty negative, they have been less negative lately, which is a good sign. We also see manufacturing activity increase in July with increased domestic and global demand. Improved energy generation capacity, which is critical as we spoke about in the introduction slide, has strengthened, which is a very imperative for its GDP. And lastly, we did see some deceleration of key consumer inflation metrics. However, to kind of balance all that, while we're back at a neutral stance, is due to that political uncertainty, that we believe is still hampering both consumer and producer confidence, and balances out some of that optimism that our lead indicators give us. Moving into inflation. So we gave a 1 in our rating, both on the current and short-term time horizon. And that may even sound generous to some, given the historical issues that South Africa has had, with keeping inflation under control. However, they have been trending toward their target range of 3 to 6%, as you can see from the Fred graph on the bottom left of the slide. And while they're seeing a little, kind of a level a bit above their target right now, in the context of the global economy and key peers, we're actually seeing some outperformance in the space. For the short term, kind of given the monetary policy attention this has received, coupled with some of the lead indicators on producer and fuel costs, we believe that this type of activity is likely to persist into the near term. And lastly, into the exchange rates here. South Africa does have a floating exchange rate policy, and you see the levels there. It's roughly 18 Rand to $1. As we look back historically from that chart, we see how much this has appreciated over time. So even compared to as recently as 10 years ago in 2014, the Rand has halved in value against the US dollar. However, kind of with that red box, I've zoomed in, within the last year, and there's a clear trend break from the norm that's definitely tough to spot otherwise from the perspective of several decades time period. So as we look at the short term, we have a bit more negative outlook here with a score of -1. Basically, we don't believe that this current, kind of currency stabilization is here to stay. The nation in February announced its intent to tap into foreign exchange reserves and gold reserves in order to service its debt. And that's a 3-year program with significant costs that, kind of coupled with other pieces on policies may depreciate the Rand. You got on top of that, the political uncertainty we've discussed, and we're slightly bearish on the short term for exchange rates. And with that, that concludes our presentation. Thank you for taking the time today and entrusting us here at RTP Capital Management, providing world-class economic insights. I hope you enjoyed this session, and please let us know with any questions or future opportunities. Thank you.